Welcome to the Universal Accounting Center's accounting course with your accounting instructor, Alan Bostrom, for Session 3, Practical Application in the Food Service Industry. In this session, you'll complete the monthly bookkeeping cycle for Stewart's Bakery. You'll do it all. You'll make journal entries, you'll post to the general ledger, you'll produce financial statements, and you'll maintain subsidiary ledgers. Now to begin this session, turn to page 3.4. And here's Alan.
Now, I want you to look, first of all, at the working capital. Do you remember how to calculate working capital? Do you? Stacy, tell us what you did. Okay, now that's the current ratio, which is one I want to get to next. But working capital is very similar. We do subtraction, don't we? Now, let's just, what is our current assets to the nearest thousand? $28,000. Okay, is our current assets, right? Mm-hmm. What's our current liabilities to the nearest thousand? 6,000. So how much working capital do we have? 22. Approximately about 22,000, right? Okay, is that good for that company?
Yeah, for that.
I would say, yeah, good. For that company, I would say it is. Now, how do we know that? How do we determine that? We use the current ratio, which is current assets divided by current liabilities, okay? So calculate, if you would please, what that current ratio is. 4.3 to 1, which means what? That our current assets are greater than 4 times our current liabilities, right? Is that good? What is the kind of the yardstick that we use, or the benchmark? 2 to 1, okay? So it's certainly better than 2 to 1, right? Now, what if Barry comes into you, the accountant, and says, you know, I need to buy another oven for my bakery, and I have 2 choices. I can either pay cash for it, or I can lease it. Which would be your suggestion? Now, that oven's going to cost about $10,000. Would you say pay cash for it, or would you say lease it?
You'd want to lease it if you can.
Okay, now leasing could be the answer. Leasing, however, you've got to look at how much your interest rate is, your effective interest rate, what is going to be the buyout at the end, and so forth, right? What's that? Now, why do you say buy it?
Because it saves on interest costs.
It does, saves on interest costs. Eventually, you'd have to pay for it. Do we have adequate current assets to be able to buy that and pay cash for it?
Yeah.
Yeah, you do.
We do. If we were to take $10,000 out of the bank account, how much current assets would we continue to have?
18.
About 18,000, something in that range, right? And how much is our current liabilities?
6,500.
6,500. That still leaves us with the 2 to 1 or better, right? Now, if on the other hand our current assets had been about 13 or 14,000, that would not have been the recommendation, would it? Because then leasing would have been the preference, because current assets are such a valuable asset to have. They're a premium asset. And by utilizing those premium assets, we could put ourselves in peril if our current ratio is not significant or sufficient enough. This is a common mistake that small business owners make. In their dislike for liabilities, they take all their current assets, their savings, and they spend them right up front to buy equipment and inventory, thinking they're doing the best thing for their business. In reality, it might be one of the reasons why they just don't make it. Okay? So we look at the current ratio closely. We watch that. We look at our working capital. We watch that so that we can identify, one, where are we right now? And secondly, what is the trend? What's been happening? We want to catch reductions in current ratio early while there's still something we can deal with. And so those are the types of things we're looking at. Now, the net income for Barry's Gas and Groceries, how much are we talking about there? $2,500. What does that mean? Well, I mean, what are different ways of looking at that?
That's how much they need in a month after taking out their expenses and everything.
That's right. That's how much they made, how much their sales were over and above their consumption, right? Okay? And had their sales not been as big as their consumption, we would have had a loss. I mean, it's very similar to at home, isn't it? You look at your paycheck and you look then at how much your groceries are and all those things. Excuse me. And what you hope for at the end of the month is that your paycheck was larger than all your consumption during the month, isn't it? And then you can take that money and put it in the savings and you still got it and so forth. Or use it for a vacation or whatever.
Or go shopping.
But if your paycheck is not big enough to cover your consumption, that's a problem, isn't it? And you have to dig into those savings or go borrow from the next door neighbor. And that's the same way it works in business. But instead of paychecks, we get sales of services or product, whatever that is, okay? So that says to this business owner that they had 2,600, was it 25 something? $25.97, almost $2,600 in excess sales. And that's what they're working for. Now, next month, what do they want to have? Yeah, they want to exceed that, right? So what are they going to do to figure out how they can exceed that? They're going to look at, one, their sales. Can we make more sales, right? Increase the sales. What's the other thing they're going to look for?
Reduce their cost.
They're going to figure out how to reduce their cost and expenses, thereby leaving them even more excess consumption next month. And then what are they going to do the next month after that? The same thing, the same thing, the same thing. And can you see how they can manage their business and they're in charge when they can do those types of things? Otherwise, they're no different than a regular employee, just coming in and doing this every month, hoping that at the end of the month, they made a profit. And sometimes they didn't, sometimes they didn't. But it really wasn't, oftentimes it wasn't because of anything they did. It was just sheer chance. And so we're constantly helping them evaluate and understand where they are in their business.